Good morning, ladies and gentlemen. Happy Friday to you all. Hope you're having a wonderful close to your weekend and a long weekend at that, being Labor Day weekend, where the market is closed Monday. But basically, today we're going to be talking about PCE. PCE came in, and it's an interesting debacle, to say the least, because it came in as expected, where we had core PCE come in year over year 4.2 from 4.1, and the month over month coming in 0.2. Usually the month over month is actually very consistent. And the year over year and month over month, both hitting that 3.3 target, going up 0.3% on the year over year, and monthly staying flat. So the question is, what does this mean for the Fed? And does the market believe it? Well, based on the thumbnail, I kind of played it off as the market doesn't believe it at all. The 89%, 1% change after news from yesterday's close to today's close, they believe the Fed is going to pause in the next meeting. And in what realm do you live in that Jerome Powell is going to look at this data and basically say this is what he wants? Like, this is Volcker's 1970s being played out in front of this man's eyes, where he has openly and avowed that he will not repeat the mistakes of Volcker. So he has the choice of, well, this can be a fluke, or I can raise rates to make sure it's not a fluke. And if it's not a fluke, then I am absolutely done, because that means we're going to get that hyperinflation runaway train. And again, going back to what Powell always talks about, doing too much or doing too little, where he's also said in certain statements, I don't know if this actually still holds true in his mind, but I would be wagering that it does, that basically you get a situation that is better to over tighten a little bit versus under tighten. As you can see here, you got straight line down and start curving up. Now, in full disclosure, we did see this from April to May, and then from May to June, we saw a decrease. So is this going to be a bump in the road, or is this going to be a meaningful return of inflation, especially with oil prices ticking up? If we jump over to the oil prices, 83.54, closing nearly at today's close, or last night's close, I should say, closing at the weekly high. Oil, again, I did say we're most likely going to get that A to B pattern completion here, sending up a massive A to B, B to C pattern, and very close to confirming it all the way up to $93 a barrel, where there is a lot of resistance zones sitting up there. So I don't think we get to 93 and just keep going. I think you hit a couple bumps on the road as you get up there, but I could easily see one of these type of rallies that we go up, then goes down, then go up again. Very simple bull flag pattern, especially if we just measure that out from bottom to top and extend it to where we hypothetically think it could go. Again, 94, 93. Everything's pointing in that direction of the market. Most likely is going to, oil is going to go up, higher gas prices, higher energy cost, higher inflation, and therefore the Fed is going to have to do more in order to counteract that inflation. If we look at the 1 year, and I'm actually going to jump over to this on the SMA chart just so you guys can see it a little bit better. 1 year, actually, or sorry, 6 year green on the day. Again, stagnating around this. These lower time frame yields aren't necessarily going to really price anything in so far until Powell actually talks. But the 1 year is kind of dabbling in that territory where it thinks it may be another rate hike, may not be another rate hike. If we look at the 3 year, or sorry, 3 month, we basically see, they're basically saying another rate hike. So the bond market's already priced this in. And the question is when the stock market is going to price this in, because the bond market's significantly bigger than the stock market. So it's going to take time for that to price in. And by the signs of it, we could maybe start getting that repricing today. We do have a Morningstar Doji style hammer-ish candle that could set up what I was referencing in the weekend deep dive as that A to B, B to C leg all the way down to 426.82, which would be to this price action zone here. That will be a strong bounce for the market. Where it goes from there, I don't know, but that would be an interesting area to see if we get a bounce there. And similar to that, NASDAQ having a similar pattern, more of a hammer style candle, where it's basically shooting up, bears defend, and actually they defended a gap. So we got a partial gap fill on the NASDAQ, similar S&P. I think it actually double topped on the gaps edge, and we could get a reversal. You do see that price is going up as volume is going down, which is the traditional divergence. Therefore, it could reverse. I don't see this move holding just because, again, this is very low volume going into the move. Like, we should now, mind you, the 50 retest is going to tell us a lot, but if we just keep going, I don't believe this move to hold up. Amazon, again, coming up above the SMAs, Google pounding up higher. So this is all pushing markets higher, but the bigger two, Apple and Microsoft, are still below their 50s. So you can't really be bullish on the market necessarily, like long-term bullish, if these are below their 50s, because it just means it's bad. Apple is trying to fill this gap, but struggling right now. Had a pretty big move on decent volume, so we have to see where it goes from there. But it had that 172 bounce. We covered this on when we covered Apple's earnings, that we said this area right here is an area that you may be looking to buy Apple. As you can see, other people agreed based on the price action, and we basically got a nice push up. But going back to the market, where I could see it playing out is that we basically reverse down to this 50, and that would again possibly signal a weekly breakdown or breakout, or failed breakout, I should say, if we close below the 45.22, or I'm just going to say your moving average. If you close below the moving average on the week, then it's basically going to be bearish. NASDAQ, similar story. You would actually close significantly lower than your moving average, basically to kind of fall in the middle of the week for the NASDAQ. But again, this is looking very toppy. That's what I would describe this pattern as. You do have that W pattern here that's forming, but that doesn't necessarily mean that has to continue. You did get the confirmation of it going up, but does it hold? That's all going to be in time to tell, because anyone can tell you, hey, it's going to bounce here. You got to wait for the price action. What I'd be looking for is that 50-day moving average retest to see where it goes from there. But with oil and Powell on deck, I don't think you're necessarily going to get a lot of bullish greed in the market. I think you'll get toe dipping. I don't think you will get full-on blown out greed. As we see here with the fear and greed index, we've basically been dabbling in neutral. 1 week ago, we closed at 46. Yesterday, we closed at 51. Now 53. We're starting to move towards that greedier territory, but we are not there yet. And again, Jackson Hole and all these things, they weren't really necessarily bullish. They weren't necessarily bearish. If we look in Nvidia stock, which is failing off the earnings to basically make new all-time highs. So again, if we're forming that head and shoulders, left head, right shoulder, head, right shoulder, then are we basically going to get that completion now, or is this basically just a topping out ascending triangle? Again, all bearish patterns on there. Now, I'm not saying Nvidia is going to go bearish, bullish. I'm just saying that there's a couple things that we have to watch out for on the way. AMD, again, chips lead tech lead spy, as people say. And right now, AMD dumpster fire. If we look at Intel, just to see what it's doing, again, pushing off, broke above the 50, but not with actually having decent volume. So again, we could see the chips start to lead again, but they're not there yet. If we look at XOX, which is the chip manufacturing basically on a whole, we see that it's barely above the 50, and now post-market is right about halfway between the 50 and where it previously closed. So we got some room to go, but overall it's looking like it wants to go one way or another. And again, when I look at this chart, and this is the basic summation of the video, is that you cannot have 89% of the people expect a rate pause at the least, right? We're talking about a rate pause, we're not talking rate hikes. And Powell's most likely not going to give you it. Like, this pricing, I would argue, would be more accurate if it was 50-50, but saying 89% of people believe that Powell is going to pause. And then in December, if we go to December, saying that 50% believe that we're not going to get any rate hikes in the future, that is a load of cow manure, because you literally just got bad data, more bad data with jobs. And basically today, at the time of recording this video, you guys be watching it, we would have Jolt's jobs report. We'll cover that on the weekend deep dive. But going just quickly to the Jolt's job reports of what they're expecting 170K non-farm payrolls versus 187. That would be a significant decrease of 17,000. But average hourly earnings is not going down. So as long as people are making money, they're going to keep unemployment and inflation high. So unemployment low, inflation high. Again, unemployment sitting at 3.5, Fed saying 4.8. So that's their target. That's the word they got from the summary of economic projections, which we're going to get again with the next upcoming meetings. So we're going to get to see what they think. But if you look at some other data that came out this week, we had Collins speaking, but that wasn't really big. Initial jobless claims below expectations, so stronger job market. Along with, we had GDP coming in below expectations. ADP non-farm payrolls, I'm not even going to talk about that just because they're all over the place. But consumer confidence and jolts. This came in very poorly for the economy. I'm not going to say the market, the economy. Consumer confidence is basically shrinking. They were expecting a significant rise from it. They got the previous one revised lower, along with consumer confidence significantly lower this month. So your base consumers are not doing pretty well. And you have like your bottom tier consumers that like buy Dollar General, for example, they're strapped for cash. If we look at Dollar General, basically just got absolutely murdered on their earnings, down nearly from the previous close, down 12%. At one point of the day, they were down 18%. So they guided lower, I believe, a lot of bad news. And you can see here, they already got one cut. Now they got a second cut. So for me, this is not showing a bullish economy. If the Dollar General, which is basically like, I'm not trying to be mean here, saying people with low income, but people with low income buy a Dollar General. If they're not able to spend money at Dollar General, then it's basically showing how tight for cash they are, that they don't have anything for accessories or anything. It's just the bare bones essential. And you can't run a whole bull market on bare bones essential. Bull markets are foundationally built on euphoria, greed, and people are euphoric and greed when there's good times, not when there's bad times. So take this however you may, but basically Dollar General cracking its lows is a really bad sign, guys. It's not necessarily a sign that we're going into like depression tomorrow, but we're heading there. We're heading towards that recession. We're possibly heading towards that depression. The yield curve that I talk about till I'm blue in the face is approaching the yellow line, which is the 2008 inversion length. So we haven't really seen this correct. And when it does, it's going to be pretty massive. And if you're on the sidelines waiting, it's going to be an awesome time. If you're in it and riding it all the way to the bottom, it's going to be a rough go for you. So I hope you guys enjoy this content. Like, comment, and subscribe. It really helps the YouTube algorithm. And throw a comment down what you thought of the video. It really helps me understand what you guys want and tailor it to you. So with that, I hope you see you in the weekend deep dive tomorrow. And if not, I'll see you sometime soon.